Hello traders, my name is Nathan. Um, Today is the 29th day of March 2015. In my video today I just want to uh, talk a little bit about um, the volume indicator and actually try to give you guys some hindsight on how to actually use this indicator to make some money. I love using volume because it's a little bit different with most of the systems that I've developed over the couple of years, and to me volume stands out because it gives me that timely entry to a trade, and which is actually what you want as a trader. You want to have some finesse as pertains to your entries with limited downside, um, 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 such that you don't have a lot of drawdowns as pertains to your entries. So if you have some finesse or timely entries, then you find that the drawdowns are less, and uh, you're not overly concerned with placing stops. I don't place stops, and I will not go to that because it's quite a debatable, controversial topic. You choose what you want to use and just use it. You don't want to trade to make somebody else happy. It's you to trade to make or meet your goals or investment objectives. So in today's videos I want to just primarily focus on strategy that I love using for my scalping accounts, which typically main aim here is actually to make some cash flow, and I primarily focus on the volume, and I just want to show you guys how powerful this tool is, and many of you may not probably know how to use it. So you may pick a few things from my video. Of course I will not speak a lot about what happens, but I will also expound and probably speak a little bit about volume spread analysis as a concept that was of course from our founding father, if I may call him, Mr. Wyckoff, whatever. So I want to focus on volume spread analysis, and I want to explain to you guys what this typically involves. Just from the word volume spread analysis, is derived from the word volume. V is for volume. Of course, we're looking to analyze the market based on the volume. The spread is actually the size of the candle, the range of the bars. We want to analyze that. That's why we derive the word VSA from, and of course this is basically what it's all about. We want to look at the highs and the lows of the candles with respect to volume. And when we talk about volume here, of course volume has no centralized exchange like the equities or the stock market has, and it's for these reasons that some traders out there argue that you cannot really quantify, or you cannot speak about real volume in Forex. And of course the debate goes on and on and on and on and on, but to me, I don't want to dwell in debating here. My main job here is to make money, and that's why I'm here today. I just want to show you how I apply this concept, whether there is real volume or not. I basically rely on the tick volume data that comes from my broker. So one thing that I want us to understand is that tick volume varies from broker to broker. So depending on which brokerage firm you're trading with, you find that he or she, they're going to provide you with tick volume that is different with another broker Z. So it is for this reason that if you actually use the same indicator across 3 brokerage firms, you find that some brokers are going to give you some setups, while the other broker your strategy shows no setup. So it's for this reason that you must understand that tick volume data is not real volume, but has a lot of correlation between real volume and tick counts. We believe that every time the market ticks up, upticks represents a buyer logically, and when the market ticks down, typically it involves a seller or selling taking place. And it's for this reason that we talk about volume in the context of demand and supply, buying and selling. So we apply this with respect to the candles. You know, we have the HOLC candles, which is from your basics, we understand that these are candles that actually plot the highs and the lows, the open and the close. I love using the HOLC charts because I'm able to see clearly what you're talking about here. I don't like candlesticks, but sometimes when you become good at this, then you can actually read any type of chart that you have. You know, with the exception of the line chart, which is actually a one-dimension representation of price. It's a little bit tricky to actually read a line chart. So here's the thing: volume spread analysis is derived from just what I've explained, and when you throw in some volume and you analyze it based on price action, then there you go, you're actually doing VSA. So I'll move further to explain some setups that I had yesterday. I mean, not yesterday, but a few days ago. And typically was setups from the euro-dollar, currency pair. And I had captured some screenshots that I've actually shared in some forums. And the basic thing here was to try and explain to you. Sorry, this is the picture. Of course, the setup was actually a breakout setup. So I love the setups because many traders get caught by the market maker or the dealers in this context of the traders. They understand the traders trade the breakout volume and the trade breakouts, price contained in a tight range, and you're there, your breakout strategies, placing buy limits, buy stops and sell stops depending on which direction you're anticipating the breakout. And this is a very big mistake among retail traders, placing pending orders and anticipating breakouts in a certain direction, and probably getting triggered and not actually price not heading in the direction that you anticipate. Here's the thing: you have to monitor volume each and every minute, if I can say so. And this is how I do it. You have to be careful not to buy into any move simply because price is actually breaking in that direction. Don't get induced. That's all I'm saying. Market makers, I'm not going to speak about them. I'm not allowed to speak about them, of course. But I will mention a few things and that are common traps that they set for us retail traders. And when you get induced to buy into a move simply because here you see a breakout above 1.09 on the euro dollar, I think it was on a Friday evening, and the basic thing as a trader you are supposed to know is that a breakout that is not backed up by volume is a false breakout. Understand? You don't buy into such moves. Simply put, you have to be very, very keen, and you have to analyze. And this is what many retail traders don't want to do their homework well, and they just trade based on emotions, and that's why the market makers love us, because they're we are very predictable human beings as far as the trading community is concerned. The retail is very predictable because they see the market breaking out, and there you go, you find a lot of buying taking place here, but only for you to actually lose some pips here. So this is what I do. I watch volume in the context of the volume bars and the volume range. I want to look at the candle with respect to the previous candles, and also I want to look at the candle with respect to the size of the range of the bar of the candle, so to say. In this context, we got a day whereby the price started moving up quite decently, quite well, and actually approached a point of interest here. Some of you call this round numbers. Some of you call them psychological levels, which is actually the same thing. Round numbers are known to offer, resistance or support depending on where price is, with respect to the zone or the line or the price level. So if we are below, then we expect that round number to offer some resistance of some sort. And the logic here is this: that price started ticking up and approached this level here. This is the point of interest. We want to analyze volume as you approach a resistance zone. We are taught to sell at resistance, buy at support, from our basics, from baby tips. But they have to go further and explain to us that volume or rather resistance does not hold forever, support does not hold forever, sorry, and it's for that reason that you have to be very, very keen to look at volume as we approach such price level, so that you just don't sell at resistance while the volume is quite high and showing or pointing for a breakout through that zone. See, so this is exactly what I was able to see from my volume indicator, that of course as we are approaching this point of interest here, which is the psychological level here, around number 1.09, then we got a high volume count, or tick volume data was very, very very high, and to me I was more interested in not trading the breakout but trading the retracement, or trading the VSA setup that arises. And this is what was shown here. Typically I use the beta volume indicator that is freely available on the internet. You can actually go there and download it. So at the eMini Watch website, of course. So download a copy of yours, and of course you can actually install it in the MT4 the software, and then you can have the the typical default volume indicator that comes with MT4 shown right here. And this is not going to be helpful if you do not understand the basic principles behind volume. So you really have to do your homework. Of course, most of the things I'm not going to explain them here. I just want to show you exactly what I look out for. 1, 2, 3. So we want to count 1, 2, 3, 4, 5, 6. We're looking at the bars. So 1, 2, 3, 4, 5, 6. Look at this doji right here. As we're approaching the psychological level here, we got a doji. What do dojis tell us? People who understand some price action will tell you that a doji shows you some battle between the bulls and the bears, and for sure somebody has to win this war, and this doji right here was my my first alarm. I wanted to check and see, by the way, this is a 5 minutes chart, so I want to check this doji and ask myself, how is the volume represented down there? And I can see that the volume was a little bit lower because it was below the 100-day moving average on the beta volume indicator. You need to understand the principles of VSA, and you have to understand the beta volume indicator, how it's been coded. Why does it, how many colors does it have? And then you have to understand what's the meaning of each color. I'm not going to go into details of explaining what red means, but of course a red bar is a buying climax. It's a climax up bar. It can also be a climax down bar, but only when smart money is taking toll on the market. And that shows some activity that we are taught from VSA school markup. Understand? But typically it's supposed to be a climax up bar showing us buying climax. Typically is going to show us a no demand zone, that buyers are lacking some buying interest. And what happens? Supply kicks in. And what happens to price? When supply outweighs demand, prices fall. See, simple basic economics, 101. So we saw some doji here with some relatively lower volume with the corresponding bars. You can see the market was actually rushing up and the volumes were actually ticking up. This is what I meant by understanding the slope or gradient of your volume histogram. When the histogram is showing some increasing gradient or increasing slope right here, and you can see prices were rising and approaching this level, we get a doji, a nice little doji. This doji was what caught my attention and showed a downtrend, and the next candle was actually popping above the doji. Look at it. It just swallowed the doji, and it showed some quite a high tick count, which is actually high volume. And then boom, what we saw was the breakout. There it goes. 45 pips spike, and what happens? Smart money, profit taking, traders taking some money off the table, and that is shown from this week. You can see a candle that is showing you a very widespread, wide range, but relatively closes a little bit lower than the middle range of the bar. Understand? So this is showing you either some profit taking So I typically wrote here and said, watch this candle's range and volume. Volume is down here. The volume is lesser than the candle that was before it. The volume is less than the candle before it. But the candle itself that has lesser volume has a bigger range than the previous candle. Do you see some abnormality there? That is exactly what you have to identify at the marketplace, and this is exactly what will make me understand that I will not buy into this move despite the fact that it's a breakout. I mean, I don't care if it's a breakout. I want to sell when everybody is buying. You get? You understand? So the volume here is showing some disparity. That is basically what we're saying, that lesser volume with a bigger range bar is contradicting what we expect. We expect big candles to show higher volume. Understand? And this disparity here is what is going to give you the setup here to actually pick a sell, and that is exactly what I did right here. And I shot this market, and I had my take profit, of course, at the psychological level slightly higher than 1.09, and I put my take profit there, and you can see the bulls were taking profit, so I sell quickly, and it's so as easy as ABCD. Yeah, this is just schoolboy stuff. Yeah, so what happened next was this particular chart that I had showed you before, that the bulls retreat, and the bears take control of this market. Yeah, bulls take profit, like I said, and the market retraces to the take profit targets. It's just easy. You have to master what you do. You have to get to understand and master. This comes through practice. Yeah, see the little retracement that I'm talking about. Look at this bar that engulfs the previous bar, and this shows you bulls are in charge right now. And you see retest of demand zone, a retest, and there, boom. For some nice 20 pips, times 2, which is 40 pips, a trade right here. Got to my target, which is actually above the round number. So keep your eyes on the volume bars, just like I have explained before, that a bigger candle is supposed to show us higher volume, but not in this case. You see the disparity there? The volume was not well represented on the price bar. So it's for that reason that you don't buy into this move, like what a rookie or a newbie or a new trader is gonna do. We sell into this move for some quick money, and this is actually volume spread analysis. This is just one part of volume spread analysis. Volume spread analysis is very, very broad, and we have scholars, Tom Williams. We have people that have actually taken this further. Yeah, and it just depends on what you apply. Mine is simple. Yeah, I look for search and I strike, and that's exactly what you're supposed to do. And the rationale is actually explained right here, just exactly what I've just said. That normally we want to see wider range bars showing greater or higher volume. And we say a volume, like I said, by saying volume is not any volume. You're talking about tick counts that varies from any broker. But it's not in this case. So we enter with a sell here, and we profit from this nice easy trade. So there we have it. Yeah, I just want to show you just one of the typical setups that we're going to encounter every day. This shows on our charts every single day. If you're keen, or if you have some nicely coded indicator that can alert you. You can get these alerts. You can get some FTP alerts straight to your mobile device. And you can trade even when you're not in your office or when you're not in your trading desk, because we want to observe the rules, and we want to trade only when there is a setup. No setup, no trade. You understand what I'm saying? No setup, no trade. This is the problem with most of us retail traders, that we want to be in the market all the time. So I just want to show you my scalping technique that I use, and it's very, very simple. Again, trading should be fun. People complicate it. Clog your charts with all manner of trades, indicators, and then you just cloud your vision, and you probably suffer from some analysis paralysis. You cannot even, you're waiting for an indicator to confirm another indicator which confirms another and another. So you have so many filters such that you hardly get any setups. Understand? So separate yourself from all that and just put in the volume histogram there, and you need to practice these things. You need to get this practiced, yeah. And the more you do it, the better you become. So to help you probably practice, you have to probably ensure that you know, we have a software called the trading simulator. Of course, you can actually do this practice over the weekend. You know, it simulates the, you know, historical charts, of course, based on some what you have to download. Sorry, the history data for the particular pair that you want to trade, and you have to install it right here. You know, it's called the FX Blue. You can download this from their website. It's freely available to anybody. Nobody should buy this stuff. Yeah, it's free. You understand? Free. So just get a copy of this thing, and of course go through the instructions on the PDF manual right there. You know, install this on your computer, on your MetaTrader 4, and once you have it there, then you have the properties. I typically scalp with about $3,000, anything between 3,000 5,000. You know, is basically my, you know, my risk capital as pertains to, you know, scalping techniques. And typically my money management is never risk more than 1%. Yeah. So it depends on what you do, but I want to trade similar stuff to what I have been taught, of course. So we're looking at the euro-dollar pair here. We want to analyze tick counts. Yeah, remember. So ensure that you select every tick, because that's how the volume bars collect tick data from, you know, from the history data. It just collects, analyzes every tick, the most appropriate method based on the available list time frame to generate each tick. You understand? So select each tick. Forget about all this others. Select each tick. Select your trying period. Of course, I want to probably test. I just want us to trade from Monday last week to probably Tuesday. You know, I just want to show you 2 days. And typically how I scalped this. Yeah. So typically what I will do is, of course, I will run it, and you know, you have to attach and select the spread here and the time frame. Oh yeah, sorry, forgot to mention something about this. I focus on 15 minutes. Yeah, 15 minutes is the market maker's time frame. Yeah, for those of you that don't know. And I want to scalp from a higher time frame because I believe that I'm going to get a better view of what how demand and supply forces are fighting it out. So I scalp on 15 minutes time frame and not a 1 minute. You understand? A 1 minute has a lot of you know, noise. So you can still scalp on 1 minute, but I reserve 1 minute scalping to, you know, some of my high frequency trading systems that, you know, we've developed over the years. And of course, slippage issues are very common. You know, the lower you go, the more it becomes a little bit harder and tougher for you to actually make some pips from it. So some of these things have to be machines trading for you. You know, expert advices, you know, some softwares and, you know, whatever. But a 1 minute time frame is showing you a smaller spectrum of the bigger picture. It's just like zooming into a certain zone and trying to identify what's going on and trying to predict the direction of the market. I mean, that's a waste of time, you understand? Unless you are scalping, you know, and you're holding trades for basically around a minute or 2, 3 seconds, 2 seconds, you cannot hack that if you're doing it manually, you understand? So you have to probably do this with the aid of an expert advisor. We have high frequency systems that do this, but the infrastructure involved is quite expensive to maintain, and the margins are simply not attractive. So why am I saying this? Is because this drew me further to probably you know, scalp on 15 minutes. That I can be able to hack very easily without having to strain my eyes, be there all the time, and, you know, checking your charts. And I mean, who has time for that? Nobody has time for that. So what you're saying here is VAC is very, very effective when it comes to that, because setups that arise from VAC are few. We want to pick HPT setups, you know, understand what I'm saying? We want to pick high probability trades. And these trades don't show up every day. They show up only when the time is right. And that's the basic importance of volume. we are looking for the middle finger effect. You understand what I'm saying? The middle finger, I call it middle finger. Why? Because we want to identify abnormal volume. The abnormal volume is what we trade, and not just the normal volume histogram bars. So that little bar that pops up, that's what you want to trade. So I will explain that once we get there. So we focus on the 15-minute time frame. We put the spread probably as 2 pips, or the current spread, depends on what you love or what tickles your fancy. Then we want to probably start this thing. So I put my template here, which is actually the trading template. Like I said, you get this simulator download and install from a free website. It's a free software. Sorry, that's what I meant. So you have to come here, make sure that your properties here, you have to allow DLL imports. I had already checked that, I can see. And then you have to say elect okay. Good. So as you can see, this is the beta volume 1.4 indicator that is freely available, like I said, from the eMiniWatch website. Feel free to download your copy. The basic thing is that you have to understand what red means, white means, green means. This is just the normal color bars. Of course, this blue, I don't know if this is blue. You know, I'm colorblind, yeah. But I don't know if this. I think this must be blue, right? This is green, and then we have the yellow, and then we have another color that is called magenta that is not so commonly seen. And magenta is just a blend of red and green. You know, when you get a color that is blended between red and green, high volume churning, you understand? High volume churns, yeah. That is basically what the green bars represent, and is a climax up bar. And then we have the white, which is controversially, some call it climax low, some call it low volume churn bars, but it just depends with when you began to read about volume, because you know, the original coder called these white bars low volume churn bars. Over the years, I can see some people changing these things, and they're calling them, you know, climax low. You know, I don't know, but just do what you do as long as you make money. I don't want to start explaining a lot of stuff, so you have to press continue here, and then I will do less talking, and I will just want you guys to watch as I place my trades, and I will try to explain what I'm doing. So so you just probably increase the speed right here. It's a visual mode, and you can see the volume tick data begins to count, you know, to trickle in, and you can see as it goes in. This typically anytime you see volume bars below the moving average, we want to look at that as low volume, yeah? Which is very common during Asian range. You see, this is an Asian range, and this is one of my templates, yeah. So you have to be able to identify the Asian range well, so that you are able to know when the London breakout comes, and then you know. So like you can see I have a low volume, you know, I have a white bar right there, and I will wait for that bar to close, and I can see it's a bullish bar. I won't pick a sell in the direction of the move. And typically all I will do is I will have my parameters set here. Of course, with you know, with about 5,000 probably I'm supposed to probably trade. Sorry, I picked a one lot, which is actually not what I'm supposed to do. I'm supposed to pick my $5,000 account. I can comfortably trade. It's supposed to be 0.5. Supposed to trade half of that, because my rule is to risk 1% of my account. So here comes another setup. We have a white bar, and then we have a normal bar coming in. And all I'm interested in here is I want to look at the volume of this bar with respect to the previous bar and the color of the bar. And you can see it closes a doji, and you see, and it was a buying setup. So I simply place a buy and walk out. Understand? So you have to ensure that number one, you have your money management intact, and number two, you have to watch the next bar, look at the volume, and analyze the volume of your next bar, which is actually a doji right here. I can probably zoom in a little bit so that you guys can see. With respect to, you can see I have my take profit hit, you know, for some nice 6 pips. I love trading and scalping for 6 pips because 6 is my magic number. 6, yeah, I was born on 6th of December, so I love number 6. So daily I will scalp 6 pips, and I'm happy with what I make. So as you can see, our growth right here is that we've just we are a little bit about we just made about $150. We just 2 trades inside the Asian range, which is actually it's possible to do this because I have this coding. Of course, I have an expert advisor that traded this. So look at this. Here's another setup. I have a climax high, and then I will be concerned with the next bar. I want to see how it closes. I want to see, the bears are coming in. You can see the bears are coming in, but the bears stand no chance. Look at that. You can see, and I place in with a buy. Looks like it picked 2 trades, but it's okay. I place a buy there because the bears are showing lesser selling interest. And I will pick it, and you can see take profit here, and that's typically how I scalp my day. And it's very easy. Like I said, trading should be fun, should be easy. Nobody should complicate. Trading should be easy and enjoyable. You understand? So I will explain the setup. You can see this is a no demand zone, and you can see this little this little red bar showed bears coming in, but you can see the bears have no chance because you look at the candle with respect to the previous candle. You can see this candle is quite small with respect to the previous candle. So all I'm interested in here is the volume count for the bearish candle, and if the bearish candle shows less volume, then I want to counter the direction. You understand? If it's a bearish candle, then I want to buy for a continuation of the move. Okay, maybe some of you will not probably understand what I'm talking about so far, but you will understand with the next few trades that I'm just about to take. There we go. You can see we have a white bar, which is a low volume chan bar, or a climax low. Depends on really what you want to call it, but as long as you can apply it in the right context, then you can see we have a bullish candle with lesser volume. A bullish candle with lesser volume is a selling setup. See, so I will definitely pick a sell in the direction of the move. And you can see I will have a little drawdown. Of course, like we're saying, nobody has a holy grail, but you can increase your odds if you do actually trade in the direction of demand and supply. So, and you can see that there I have my take profit hit, and then I have so right now I'm a little bit above, maybe I'm up a little bit over 40 pips or so, not 40 but 20 something pips, so I would count that. So I have another setup right here. You can see we have a bullish bar, we have buyers coming in, but I'm looking at the volume of the buyers and they are less, so I pick a sell. You understand? That is very easy for us to do. Is what we call schoolboy stuff. Yeah, and you have to be very, very keen when this happens, but logically it is easy if you follow the rules, and if you follow the basic concepts that we're talking about here. So I will basically get more time to explain some of these setups, but with that I just want to show you that trading should be easy. You can scalp, you can actually day trade with some of these strategies, and remain profitable going forward. So I will probably explain a little bit further what the colors mean in the near future in my next videos, but as you can see, it's time for me to go have some dinner, and I will look forward to making a more detailed video in coming days, and probably seek to answer most of what you people have been asking me through your emails, through your inboxes, and I will seek to give you more clear answers. But for today, I just want to explain 1, 2, 3. Look at the volume with respect to price, range, and then counter the move for some easy money. And that's basically my day trading strategy that is basically a scalping technique on a 15 minutes time frame. So I will want you people to actually practice. If you have learned something from this video, good. If you have not picked something from this video, then I want you to do your homework, read about volume from Wyckoff or Tom Williams, and look at the basic principles here, you know, in the context of what you're looking to apply, and trading should be a little bit easier for you. So that said, I want to finish this video. I want to go grab something to eat, and then we can probably talk, or I mean not talk, but I'll probably engage with you people in subsequent videos in coming days. Understand? So I wish you a successful trading week as we approach the Sydney Open. Today is Sunday, yeah, and yeah, be very careful because it's the first week of the month. Trade very safely, and I will probably make another video on the non-farm payroll and show you a little bit one or two secrets that I mean, not really secrets. I will show you some techniques that I use to trade the news. So that said, I want you to wish you a happy trading week, full of peace and full of happiness, and be well, and I will speak to you.